Maybe you've spent decades saving for retirement, building what you hope is enough to live comfortably. Maybe you've hit that age where you've never really planned, but you think it's time to pull the pin and you're wondering if you can. Almost every retiree ends up asking the same question sooner or later. Am I doing okay compared to everyone else? Today, I want to show you exactly where you stand, and more importantly, talk about why the answer probably isn't what you expect, and that maybe you're asking the wrong question. Hi, I'm Stefano Francesca, Certified Financial Planner Professional and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. I've sat across the table from hundreds of retirees who did everything right. They saved consistently, they avoided the big mistakes, and they still wonder if somehow they're behind. Here's what surprises most people. The answer has almost nothing to do with the number I'm about to show you. Statistics Canada puts the median after-tax income for single seniors nationally at around $38,600. If that's your average income or you're below it, you probably are relying heavily on CPP, OAS, or Guaranteed Income Supplement. For senior families, it's closer to $83,200. Half the people in each group sit above that line, half below. If you live in Alberta, there's a wrinkle worth knowing. According to StatsCan, Alberta has the highest median after-tax household income among the provinces, $85,300. That's ahead of Ontario and well ahead of the Atlantic provinces. Now that's across all households, not seniors specifically, but it tells you something real. Albertans, on average, have more room to work with than most of the country. And yet I still meet people here sitting on more than most of their peers who feel like they're falling behind, and others with less who seem completely at ease. Why is that? So the provincial number, like the national one, doesn't actually answer the question you're asking yourself at 2 a.m. Most people hear a stat like that and immediately start measuring themselves against it. That's usually the first wrong turn. If you're wondering how your own retirement income compares, not to provincial averages, but to the retirement you actually want, I've included a link below where you can book a retirement planning call with me. You see, if you don't have a plan, you'll never have a map to tell where you are. Worse yet, you'll use the wrong measurements to guide your success. I've always said that it doesn't matter where the averages are. Your plan is the only guideline that matters. Now, you're building your personal retirement income from 3 main places: government benefits like OAS and CPP, a private pension, if you're lucky enough to have one, and whatever you've saved on your own. The maximum OAS pension is roughly $9,000 a year, depending on your age and when you start receiving it. The maximum CPP retirement pension at age 65 is roughly $18,000 a year, though most people collect quite a bit less than that in practice. The average Canadian retiree collecting CPP at age 65 receives closer to $10,000 per year. Only a majority of retirees receive income from a workplace defined benefit pension plan, which leaves your own savings, RRSPs, TFSAs, whatever sitting in non-registered accounts or retained earnings in a corporation. For many retirees, that's where most of the uncertainty lives. And it's this piece that lets 2 people with the exact same number end up in completely different retirements. Let me show you what I mean. 2 retirees both earning $55,000 a year. Retiree A rents a condo in downtown Calgary, has no pension, and watches her savings shrink a little more every year as higher rent and lifestyle expenses creep up. Retiree B owns her home outright in small town Alberta. She has a modest pension from years of working with the municipality and just got back from her trip across Canada to visit her grandkids. Same number, 2 very different lives sitting underneath that same $55,000. So if the number itself can't tell you whether you're okay, what can? Forget comparing yourself to strangers or to a provincial average that has nothing to do with your life. Compare your income to your own spending. So start with the essentials: housing, food, healthcare, insurance, transportation. What's the bare minimum it takes to keep the lights on? In Alberta, that math shifts a lot depending upon where you live. A paid-off acreage outside of Red Deer costs a fraction to run each month compared to a rented apartment in downtown Edmonton or Calgary, even with the heating bills our prairie winters bring. Then layer on lifestyle spending: vacations, hobbies, dinners out, travel, helping family maybe, or other charitable activities. What does the retirement you actually want cost, not just the one you'd merely survive? Most people land somewhere between 50% and 80% of their pre-retirement income. But again, that's just a rule of thumb and not a personalized plan. But here's what tends to catch people off guard. Some spend more in the early years, finally doing everything that they've been putting off. Others spend far less because the mortgage is paid and the kids are gone. There's even a pattern researchers call the spending smile. More spending in your 60s while you're active, less in your 70s as things really slow down, then possibly more again in your 80s as healthcare and long-term care costs climb. A flat income projection assumes your needs stay identical for 30 straight years in a row. And life just doesn't work that way. The vast majority of you will need to model a laddered or phased income approach. It's going to map a more realistic spending pattern. So if you're 65 and money feels tight right now, it's worth asking yourself honestly whether that's permanent or just a phase you're in. Once you know your number, there are really 3 questions worth sitting with. 1, can you cover the essentials with guaranteed income alone? CPP, OAS, any pension you might have. If the answer is yes, everything past that is lifestyle, not survival. And that realization alone brings real peace of mind to many. 2, do you have room for surprises? A new roof, a health scare, helping out a family member. That's what your savings and your TFSA are actually there for. And then there's a question almost nobody thinks to ask themselves. 3, am I spending in a way that actually matches what I value? I've watched people hoard money out of fear and miss the retirement they spent their whole life working towards. I've also watched people spend way too freely early on and pay for it with anxiety later. Neither one gets you where you want to be. What you're really after is some alignment between the number in your account and the life you're actually living or looking forward to living. If you've never sat down and mapped your income against your real needs this way, you're not alone. Very few do. Many end up mapping their lives to the situation they've arrived at, rather than planning for creating the income that's going to allow them to do all the things that they want. That's exactly why we build retirement income plans with clients that skip the averages entirely and focus on what actually matters for their life. So here's the takeaway. Whether you're above or below the national median or even the Alberta median, changes almost nothing about whether your retirement actually works. What matters is whether your income covers your needs, matches your goals, and leaves you room for whatever comes up that you didn't plan for. Life is messy, so you don't need a perfectly mapped out plan. You need a flexible plan that can move with all the things that life throws your way. If you'd like to see what your own numbers say about your retirement, book a time with me. It's part of our Next Step Wealth Management service. Links in the description below. Let's take the next step.